Hello, everybody. Welcome to yet another episode in our Coaching Connection. We are actually taking a break from podcasts, but when I came across our today's speaker, Lisa, and she shared with me what is it that she is passionate about, and she shared a little bit more about her story, her background, the challenges, financial challenges she's gone through. I thought this is a very, very important topic, and I opened the slot up just to host her here today. As you know, we talk to people in our community, we talk to other coaches, we try to understand what's happening in their lives, what's going on in their lives. And time again, we hear how people has gotten out of hand. The amount of money coaches spend on programs and other coaches' services and so on and so on. And often they indebt themselves to pay for all those services. And the amounts that I hear is just mind-boggling. It's just mind-boggling. It's good on those coaches if they can actually get paid so much, but for the people, us normal people, getting into this debt and then hoping one day your coaching business is going to take off and everything is going to be worth it. But often that takeoff is maybe years, if not decades away. And so I really thought it's important we talk to Lisa today and hear her story and hear what she's got to say, what advice she has for us and how we can get on top of our finances again and start becoming like managers of our finances and not overburden ourselves financially for the sake of that magic bullet that's going to move our business. So Lisa, over to you. I know you prepared the presentation. I know you have slides as well, so I'm going to allow you to share the screen. So just go ahead and introduce yourself and share with us more. What is it that you do, your story, and whatever else you have to say to our community.
Well, thank you so much, Rena, and thank you for everybody for welcoming into your community. I am a certified financial educator or coach right now. I'm also a registered representative. My journey was probably a lot like many of yours. I actually have another business as well, a marketing business for 18 years. And I also, like you, always felt like, that next thing that comes along is the best thing. It's going to catapult me into the next level in my business. And unfortunately, all it did was make the other people richer, made me poorer, and didn't really get me to where it was promised to get me. So I totally understand about that hoping and faithing. But what I was missing and what I didn't know I was missing was the financial literacy. Financial literacy is the key to success in whether it's in your home, whether it's in your business, you need that financial literacy. And I wish I had someone like me, and my partner Tracy's on, so I'm excited. She's on this call listening as well. Hi, Tracy. I wish I had someone like Tracy and me to come to me and tell me how to manage my money, how it worked, and how to have it work for me instead of me grinding and working so hard for it. So when I came on with absolutely no financial knowledge whatsoever. And you can't fix what you don't know, right? So I went every day hoping that the next day would be better and better, but it wasn't getting better and better. And so now that I do know these financial concepts and I understand it, I'm not only applying it to my home and my family, but I'm able to apply it to both of my businesses, this business and my marketing business. And I'm seeing differences already. I know that Rena mentioned debt. I actually came into my financial agency business over $100,000 of debt. I know many of you, if I could see a raise of hands, would probably say, hey, I feel your pain, right? It's a real thing and it's scary. And nobody in the industry could show me how to properly pay this debt off. They kept asking me for money to do it, and I didn't have money. So I try to struggle the best I can. And later in this presentation, we're going to have a portion that's going to deal with debt management. So we'll go a little bit more into it. But I learned a really valuable tool and a way to pay off that debt better and faster. And now a year and a half later, almost 2 years later, I've paid off a little bit more than half my debt. I'm on the road to recovery, and I'm not going to get back into that debt. That's a very important thing. A lot of people pay off debt, but then they find themselves getting back into it. So I'm really hoping that what you take away on these 7 financial milestones that we're going to do, this is actually part 2 of a 2-part class that I do. It will be using a book. You'll see the book in the beginning. There'll be a little intro to the book that we use. You can find the book, or you can ask me. I would gladly send you the book. And you can start to be on the road to recovery and getting empowered and taking back that power over your money that it has over you. So that's how I'd like to just do a little bit of intro, Rena. And I'm going to start sharing my screen. Rena, like she said, she's going to be looking for questions. I am laser focused when I'm doing this, so I'm not going to be looking for questions, but I do believe we have a question and answer period after. So please feel free to ask. No question is too silly, or I know people say I have a stupid question. There's no stupid question. All right, so please feel free. Right now, I'm going to hopefully share my screen properly. And my info is in the chat already if you want to reach out. I know Rena will be doing that a little bit later as well. So hopefully you're going to be able to hear the video. If not, Rena, please come off mute, let me know, okay?
We cannot hear anything. So if there's supposed to be sound, we don't hear.
Let me just get back. Let me stop sharing. And I think that's what I did. I forgot to share the sound. I apologize. Okay, let's try this again.
We buy into it.
We good now?
How bad is financial illiteracy?
It's not taught in school, so people don't know this naturally.
Oh, you're right.
So you grow up not knowing anything about it. You make a lot of mistakes along the way, and we're hoping to educate them and teach them how money really works so they can learn the cause and effect of all this.
And it doesn't have to be generational.
Exactly.
No.
Exactly right.
Break that cycle.
Once you understand the basics of financial literacy, it changes your life. The secret is financial literacy. I mean, teaching your kids how money works. I think it's really understanding how money works. Once they understand the basics of how money works, they shouldn't have to struggle for very long.
Steve Siebold and Tom Matthews are the authors of How Money Works. Stop being a sucker.
Money means possibility. It means opportunity. It means freedom. Things you've always wanted to do, dreams that you have. Money makes it possible.
So basically, Tom Matthews and Siebert are the authors of How Money Works. Don't be a sucker. Love this book. It's simple. It's easy to understand. Again, at the end, if you want to reach out to me, I have the book that you could send. But we're going to base this class on that book. So there's going to be some characters that you're going to see. These are the characters. Aren't they cute? They're different characters, and they come from different financial viewpoints. And I know it's a little bit hard because you don't have the book, but we'll make it through, and we'll explain it. And I'm sure that some of you will resonate with some of these characters and say, hey, you know what? That does sound like me. Wow, that's so cool. I didn't understand that before. So let's take a deep dive into this class, and let's start learning how money works and how not to be a sucker. We're going to cover these 7 money milestones. We're going to start with the financial education because we need to have that foundation in the beginning. And then we're going to go to the proper protection, having an emergency fund, debt management, and cash flow. Then we have building wealth and protecting wealth. So basically, this is a step-by-step action plan designed to help you chart your course from where you are today to financial security and independence. And the good news, you know what? Nobody is too far behind or too far ahead to benefit from these milestones. Whoops. Okay, so the first thing is financial education. This is the building block to everything. The reason that I had so much trouble in my business and in my personal life was because I didn't have financial literacy. You know, that's a very big thing. A financial professional, a lot of people want to do it on their own, but you as coaches especially, right, would understand that, you know, sometimes you just can't self-guide. You just need, even as a coach, a lot of you probably use coaches because it's just so much introspection that we can do on ourselves. So using a financial professional is a good way to go, and to find a good financial professional, and that we can discuss that later on after we're done on the questions and answers. So let's go on to, there's my pop-up. So in your war for your money, there are 2 essential tools you'll need to win. We know that the best starting point for everyone is to combine a financial education with a financial professional. And you have to take this education seriously. So you can sit with someone, they can give you the tools, But if you don't implement, if you don't use the tools, you're no better off than you were before you sat with them. So let's take education seriously. Most of us, where do we learn how money works, right? We're not getting it from school. Our parents can only teach us what they know, and sometimes what they know isn't even the correct thing. My parents never put any kind of importance on life insurance or emergency fund. They didn't know. I thought because I can balance my checkbook and pay my bills that I had arrived, but I was very far from that. I learned the hard way that that was not all I needed. So you have to treat your finances with the level of dedication you put into your health. Google things, ask questions, but then turn to someone you trust that does this for a living, a financial professional that you know can teach you, not just sell you a product or push something, but actually teach you. So here are some of our characters in our book. I love these guys. This is George and Dana, and you know, George is saying, Dana, you're smarty pants. Can I get you to be my financial pro? And she's going, well, you need someone licensed and trained. And she's right. This is the time when you can put everything you've learned into action with your financial professional, who can then assist you to crunch the numbers, chart your path, choose products, stay accountable, and course correct along the way. This is really not something that you want to try alone. It really isn't. So remember what the Art of War author Sun Tzu said. Without local guides, your enemy employs the land as a weapon against you. We all need a guide, and you as coaches in all different areas know that you are your clients' guides as well. And make no mistake, we're battling forces that are actually wanting to control our money, so we remain a sucker for life, right? If you don't understand how your money works, then people can take advantage of you. They can say anything to you and promise you the moon, and it sounds good, and you're like, yeah, I'm in, but it's not good. By going through this course with us today, you've made the decision that you're going to establish yourself with financial literacy, and that is the most important thing. So you'll have completed this first milestone by the time we get to the end of the hour. So now the second milestone is proper protection. And this is really, really important. This is an absolute must. I never ever was growing up understanding what proper protection was and how important it is. But now that I'm in the industry and I'm seeing so many people's lives shattered when they lose a loved one and they don't have proper protection, there's no life insurance in place, and now they're crying over the loss of their loved one, and now they don't even know if they can keep their home, if they can keep on living without becoming a burden on their family. And so you need to protect yourself and your family from a possible future loss of income or savings before you begin the rest of this journey. If you were to die prematurely, would you have peace of mind that your family could be left alone without your income coming in addition, without you being here? That's a big question that you need to ask yourself. And so when I came on board, that was the first thing that my husband and I got. We realized how selfish we were being to our kids by not having the proper life insurance. And so we were able to use our current savings to, get a plan that was right for us. There's many different options. And this, I'm not here to go through any specific options, but I'm just letting you know that my mind was blown when I came and found out how many different insurance options there were and how long I wasted not getting it when I was younger, when I was healthier, because age and health make a big difference. And that's what we're going to get into today. I always miss the part. There it is. So let's take a look here. Though protecting yourself is more important than protecting your property, as Thomas Paine put it, you might not be able to fully protect yourself from illnesses or accidents, but you can protect your income and your wealth. That's what life insurance is all about, protecting your income and your wealth for your family. And ironically, protection of your financial assets is called life insurance, right? It's insuring your life. It's a defensive strategy motivated by a sense of love, responsibility, or both. It's saying, I love my family so much that I don't want them to have to worry about that if I pass away and they lose my income, that they're not going to be able to survive. That's why it's full of love. And I don't know, I know some of you are out of the US, but in the US, we have what's called GoFundMe pages We are trying to get rid of those. Nobody should need a GoFundMe page when they have proper insurance. Okay, so now we are, okay. Okay, so how much life insurance should you have? It's a really good question. How do you calculate that is? Well, there's a certain rule of thumb as a starting point. You really want 10 times your annual income. This way, you know that your family is able to survive for at least 10 years if you passed away. Now, we recommend having more, especially because you have other expenses, like, you know, you have children's education. Maybe you have children that want to go to college. Maybe you have a home that you might need to pay off, or you have some kind of debt. There are a lot of different other little things that go in, but as the rule, you're going to do 10 times your annual amount. And in this example, if you're earning $50,000 a year, you want to have at least $500,000 worth of coverage. In our agency, we like to make sure our clients have at least $1 million worth of coverage, and we can achieve that in different ways to keep within the budget of the client. So, like I said, that's where you want to have a financial professional that you work with that's gone through this and that knows how to help you figure that stuff out. So if we want to get into more specific calculations, like I was saying before, is we want to ask the financial professional how we can get a little bit more than just our coverage. But the factors that you have to consider, and this is why the earlier you do it, the better, because life insurance depends on things like how old you are, how much debt you have, what's your health, how many number of dependents that you have, your role in your business, and actually your overall financial situation. The older we get, the more expensive life insurance gets. The least healthy we are, the more expensive life insurance gets. This is something that you need to do as early as possible. And what most people don't understand is that if you do it early, you lock in your health rating. And if you have permanent life insurance, you will never have to worry. God forbid you get sick later, they cannot take away your life insurance policy. But if you get sick later and you try to get one, you can be denied. So this is why when our clients sit down with us, we've actually put life insurance policies actually on children. We can make $1 million babies when they retire. So this is something that should be looked in a little bit more closely with your financial professional. So now many people like Dana here, they didn't know that 10 times the income was just the starting point for protecting the income. And it sounds expensive, but you need to look closer into it before you decide you can't do it, because you might be very pleasantly surprised. The same people who underestimate how much life insurance they need have a tendency to overestimate how much it costs. And I get that all the time. When I sit with clients, it's like, well, I can't afford this, or someone told me in my job that it was too expensive. So that is not true. Both assumptions could actually keep families from putting proper protection in place. That's a very, very, very bad thing. As insure.com says, only 59% of Americans have life insurance, and about half of those have too little. They are underinsured. So if they pass away, their family is going to be left holding bills, holding a mortgage, and having to deal with children possibly going to higher education. So you and your financial professional, whoever you choose to work with, should cover your short-term and long-term debts, other outstanding loans, your financial goals. What do you want to do short-term? What do you want to do mid-term? What do you want to do long-term? Your mortgage, your rent payments, how old your children are, and how much their education could cost. I know that education here in the United States is very expensive, and most of these kids come out with crushing debt on them. And so these are all things that your financial professional and you should look into when you're looking into how much coverage that you need. So just like with so many other things, life insurance with all the options out there seems complicated at first. But once you know a little bit, it does become a lot simpler. To start, it's important to understand that all life insurance usually falls into only two categories. That's how simple it is. You either have temporary or you have permanent life insurance. So now let's look at term life insurance. That is temporary. If you think about term insurance as renting a house or leasing a car, right? You don't own the car or the house, and you're paying rent to that, or you're paying a lease payment. And then when you walk away, you don't have anything. You've done what it needed to do. It was there for the time you needed it, and you walk away with no asset, right? Well, term policy is very much the same. It's for specific time periods in your life. It could come for 10-year term, 20-year, 30 years. Sometimes it's 15, 25, depends on the company. It's the most affordable life insurance available because it only has one feature. It's a death benefit. The money paid to the beneficiary when the insured dies. And because it expires after the term, you don't get anything anymore. That's why it's cheap. It's like if you buy a car and you just don't have, air conditioning and you don't have all the bells and whistles, you're going to pay a lot less than if you start adding on bells and whistles. It's the same for term. It's only to cover a most important, expensive part of your life. So with term insurance, it's possible to have financial protection of your family or business with a relatively small monthly payment. So when I'm showing this, I'm talking more in family and individual, but we do life insurance for businesses too. That's a whole nother discussion, which we're not going to get into now, but businesses can definitely use life insurance for a lot of reasons that we can discuss later on if you have questions about that. But this can make it fit for everyone with a limited budget during times of highest financial responsibility, like raising your children, paying off things like a mortgage, running your own company if you're a business owner. This is very important thing so that if God forbid anything happens to you, this life insurance policy will pay off to help your family pay off the debts and not be burdened with that. But what happens when the term on your life insurance ends? Well, there are only two scenarios you could look at. Scenario one is that, well, you don't need the coverage anymore. You could just simply let your policy end. No fuss, no muss. Children are grown. You don't have maybe your business. You sold your business. Your house is paid off. All that good stuff. But what happens after your term if you still need the coverage because you're still paying off your home, or you're a single income family, or maybe now it happens a lot more than not, is you're supporting grown children or grandchildren, or you're still running your business. For these reasons and others, you might consider scenario 2, which is keeping the term, but there is a little caveat with that. Did it move? Okay, good enough. If you're in good health and your term policy has guaranteed insurability, which means they're going to keep insuring you, you might be able to renew the policy. Remember, if you want a completely new term policy, you'll probably have to qualify medically again. But if you can't qualify, a new term policy might not be an option. If you do qualify, the new policy is going to cost you more. Why? You're older. And remember, that's one of the prerequisites with life insurance is your age and your health. So the older you are, the more expensive the new term life insurance will be. So I sit with a lot of clients and, they'll get a term policy and the company says, oh, don't worry, after 30 years, you can renew this. But they fail to tell them that when they renew them, if they got this policy at 40 and now they're 70, well, when they renew it, it's going to be a lot more money. And this usually comes as a shock. And so that's why we like to educate and make sure our clients know everything. Now, this is what we call the financial X wave. In our younger years, represented in the blue on the left side, you typically have more responsibility, you have less accumulated wealth. In your later years on the yellow side, the plan is for your accumulated wealth to increase as your responsibilities hopefully decrease, right? Your kids are grown, you paid off your mortgage, all that good stuff. Now, term insurance is typically most useful when your responsibilities are higher and the wealth is lower, right? Because it costs less, the left side. If these two factors flip later on in life as planned, term insurance becomes less practical. You don't really need it. And that's when your financial professional could help you look at how the X wave could be applied to your situation. So now we've talked about term, let's talk about permanent. So like term, it does provide a death benefit to protect your family financially, but permanent insurance is designed to keep and protect you for your entire life, not just for a specific time period. Think of permanent insurance as a lifelong strategy, as like owning your own home, owning your own car, right? It's a strategy that can protect your family today and secure your wealth in the future and provide for your family well after you're gone. There are 3 important benefits of permanent life insurance. Number 1, life insurance for your entire life, right? You never can lose it as long as you're paying your premiums. It doesn't matter how your health, your health takes a turn for the worse, this permanent policy is yours throughout your life, usually till 121 years old. 2, with many permanent life policies, you can add things like long-term care as an additional rider. Now, a rider is, if you think of a motorcycle as a life insurance policy, and the rider is that sidecar. It doesn't, the motorcycle can keep going without the sidecar can't keep going without the motorcycle. And so we can add for relatively little cost different riders to take care of things like long-term care, which could get very expensive later on. Healthcare costs are extremely expensive and the major cost for bankruptcy for most people as they get older. And number 3, your accumulated cash value, which gives you flexibility with the premiums. And that means that if you ever can't pay your premium, for some reason, they can be paid out of your cash value. And there's even ways to use permanent life insurance as life insurance retirement plans. That, again, another conversation, but there are beautiful ways that you can get another stream of income from a permanent life insurance policy in retirement. Now, other benefits that could be included with permanent life insurance strategy can be advantages like absolutely no market risk. How many of you have ever heard that you can have something where you never lose money, right? Not me. When I first came here, I thought the only way that you could even grow your money was to risk it in the market. But I promise you, there are life insurance policies where you have absolutely no risk of losing any money while you're building up your cash value in that policy. You have long-term care coverage like we discussed. Tax-free growth. When you put in your premiums for a life insurance policy, you are using money that's already been taxed. Now it's allowed to grow tax-free for when you take it out later. You don't have to worry about how high taxes might be in the future. Avoiding taxes is extremely important to consider because it can directly and significantly impact how much money you're going to live on in retirement and how much you're going to leave to your heirs. It's called leaving a tax-free legacy. I mean, I know I probably can't see anybody's hands, but how many would love to leave a nice legacy to your loved ones and it's tax-free, right? Who wouldn't want to do that? Let's talk about the cash value component of a permanent life insurance policy and why it's so important. A portion of your monthly premium is set aside in your account that grows over the life of your policy. The money in that account is your cash accumulation and can be used to fund future purchases of your premiums if you can't pay a premium for a couple of months. You see a few possibilities on the screen. You could actually borrow from your own life insurance policy to go on a vacation, to buy a new car, to put a down payment on a house. Maybe you want to start another business and you just need capital. Maybe you want to buy real estate. This is what you can do, the power of cash accumulation policies. And in addition, there's no market risk in tax-free growth, income, and legacy, as we just mentioned. Life insurance cash value can be also creditor proof, which means, God forbid anything happens and you have to go into bankruptcy, which I hope you don't after hearing my class, but if you did, the creditors can't come after it. It doesn't matter how much money you have in your life insurance policy, they cannot touch it. When you look at them all together, the advantages of the cash value benefit can be very powerful. So now we saw that long-term care can be added to a permanent life insurance policy as a rider. So let's talk about the importance of long-term care insurance for a moment. You may not know this, but 70% of people age 65 and over need some type of long-term care services and support at some time in their life. In other words, statistically, you will likely need it. And long-term care kicks in when you can't perform 2 out of the 6 daily functions of life, like maybe bathing, mobility, eating, anything like that. And so these life insurance policies using the long-term care rider will actually accelerate the death benefit. That means you're able to use your death benefit while you're living. This is a living benefit on a life insurance policy. These are all things that Tracy and I didn't know before coming in here and learning this. And this can make such a difference in your financial situation and why this is so important. Now, long-term care insurance can help cover out-of-pocket expenses that really add up. It can be used to pay for qualified services like nursing home care, home health care, assisted living care, adult daycare, and you never know if or when you might need it. You can't get sick and then decide, oh my gosh, let me put a long-term care rider on this, or let me get that. It needs to be done beforehand, and we never know when it happens, so it's always good to have this kind of peace of mind. And if you do, the average long-term care, if more than 1 year, lasts 3.9 years. And as you can see here in this little chart, the average total cost can be crippling expensive, not covered by a policy. The cost without long-term care coverage could drain one or more of your savings asset you were counting on for the future. This is an extremely important topic that most people don't like to discuss, but you can see how necessary it is. There are a couple of long-term options you should look at. The first is traditional standalone policy, but that's very expensive. So if we can put it as a rider on a permanent life insurance policy, it's pennies per month, and this protects everybody. And if you haven't heard of these options, you should talk to your financial professional. They should be able to help you with that. Now, if you go with option one and buy a traditional standalone policy, there are a few things you should know, like the fact that premiums start low, but insurance companies start to raise them. Also, you usually pay for care upfront out of pocket, and then the company reimburses you, which can be seen as an inconvenience during a difficult time. Another thing to keep in mind with the standalone options is that you could spend thousands on premiums and get nothing back in return. If you never use it, you've just lost all those premiums. And also there's a 70% chance you'll need long-term care, but there's also a 30% chance you won't. So it's a use it or lose it kind of situation. However, if you're adding it as a rider to a permanent life insurance policy, then even if you don't use it, you're paying pennies per month. If you don't use it as part of your death benefit, you still have your death benefit. So it's not a lose it or use it kind of situation, which is why it makes more sense to add it on as a rider to an existing, to a permanent policy. Whoops, sorry. Life insurance also has other living benefits such as critical illness, chronic illness. These are the things that are added onto these policies. So as you can see, basically what I want you to know is life insurance isn't just a death benefit. It isn't just whether you die or not. There's a lot of things, and now they're adding the living benefits and other things, even using it as a retirement plan. So this is the main part of this. Now, this is a fun part, an emergency fund. As I told you before, I never knew about emergency funds. This is how we want you to have it: 3 to 6 months of your annual income to prepare for any unexpected expenses like unforeseen medical bills, home appliance repairs or replacements, hassles like major car fixes, and don't forget, costly of all, possible unemployment. Now, I also tell business owners that you should have an emergency fund for your business as well. What happens if business is slow for a little while? At least you know that you have something in the bank that you can pull out and not have to put yourself into debt. So if you're currently living paycheck to paycheck like many people are today, your emergency fund could be an insulation that separates you from a financial disaster. Check out some of these sample annual incomes and how much you'll need to fit 3 to 6 months of income into a guideline. If you want, you can take a quick screenshot. I know you don't have much time to write it down, but this is just a guideline of what you can do. And of course, if we're sitting down, we do a more one-on-one focus, so we can actually tell you how much you would need for your particular circumstances. But at least this gives you a general guideline. Now, TJ has this good question, which you might be thinking too: where do you get the money to create an emergency fund? Well, especially if your income is tight and you have to put a little away each month, it's better to start growing it. You're not going to have a lump sum that you're going to put in, but you're going to take out a percentage. We normally say 20% of whatever money you have left over after you've gotten your paycheck and you've paid your bills. Think of it like a debt payment to yourself. It's due until you achieve your financial goal for the emergency fund, and then you can start putting that money into something else that you and your financial professional have talked about. So there are 2 rules of an emergency fund. Rule 1, you have to promise yourself it's only for emergencies. It's not to get tickets to the theater or to put gas in your car or to buy a new dress. All right. It doesn't matter if it sits in your checking or savings account, as long as you're not tempted to use it for anything else other than emergency. Rule number 2, if you need to use it, you need to replace it right after. Don't hesitate to use it if you have to replace it for the refrigerator or pay for brakes on your car or braces for your kids or whatever. But you need to start replenishing it again. Don't deplete it and not put the money back. This is called financial fiscal responsibility. So now we get to the fourth milestone. This is the debt management. And this is what I was really interested when I first came in, because as I told you, I was $100,000 over in debt. It wasn't anything frivolous. I was paying my bills. My husband had double hip replacement. We didn't have any kind of any savings in the bank, nothing. And so we had to take cash advances on credit cards. And so we got into debt with compounding interest. But this is something, before you can fully enjoy a financial security, you need to look at your spending habits and strive to reduce and eventually eliminate your debt. So let's take a little bit of look into this. So we hate to say this, but in our culture, honestly, debt is a sweeping crisis perpetuated by a society of suckers. And I was a sucker, okay? Led astray by the instant gratification of the generation. Now, on my home thing, no, I was paying my bills, but in my business, I told you, I kept falling for things like, oh, you've got to take this course and then it's going to skyrocket your business. You're going to get 10 times more customers and all this. And so I got myself into debt with my business also, not just my home. So that's a problem. And there's no shame in admitting that you struggle with debt, as it's one of the most common threats to a sound financial future. But it's something that we have to face. We have to talk about it, and we have to get with a good financial professional that's going to give us a strategy and hold us accountable, very much like you as coaches hold your clients accountable for the goals that you set for them. So now let's take a look. The average American today is almost $30,000 in personal debt, not including their mortgage on their home. And many have much more. Look at me, right? And I had it in my business as well. And don't forget, over half of the Americans are suffering some kind of anxiety relating to this debt. When the debt is removed, we can enjoy life more fully and more freely and breathe better. I know that I'm doing much better since I paid down half of my debt. I feel like this big millstone's been lifted off of me. So things have been hard with all that's been going on right now. So here are 5 tips to eliminate and stay out of debt. You have to know what you owe. When I first came here, I really didn't know how much I owed on my credit cards. I had this wild kind of, generalization. And they made me look at it. They made me write down everything. I was scared. I wanted to put my head in the sand like an ostrich. But you have to know what you owe. No more late payments. We're going to go after one debt at a time. And we're going to go after the debt that has the highest interest level, because there's a rule of 72 that we didn't get to. That's in the first half of this course, where you take the number 72, divide it by your rate of return, and that tells you how quickly your money's doubling. So if you're in debt, if you have a 25% credit card interest rate or whatever the debt is, your debt's doubling every about 2.5, 3 years, which is why I was having trouble getting out of debt. I had some credit cards that were 29%. So you have to go after the one debt, but get to the one that's the highest and work your way down. Stop charging. Stop using your cards frivolously. Stop spending money frivolously. Really look into something before you say you're going to do it. Can this person deliver with what they're saying? Sometimes if it's too good to be true, it's probably not true, right? We have to come to that conclusion. And cancel any unused subscriptions, because I've had people, I sit down, they've got a whole bunch of subscriptions to Netflix and Hulu, and they have the gym membership that they never go to. Take a look and see what you have and what you can eliminate. And then consider refinancing your mortgage to see if you can get a lower rate. Right now might not be the time, because I know in the United States, the mortgage rates are high, but this is something to keep in mind for the future when they start to come down. So let's dig into each tip, knowing with what you owe. So I suggest you make a whole list of your credit cards, your debt and loans. It may sound very tedious, but it's necessary. Remember, when you're talking to your coaching clients and you want them to make a list of all their goals or their affirmations or what they feel that their weak spots are, right? They like moaning and groaning. I did the same thing, but you have to put down your list. You'll feel so much better when you have your arms around those numbers and the information. For each debt, write down your numbers and dates, write down your interest rates, write down how much you owe total, how much your minimum payment is, and how much you've been paying. You need to know these things. You remember, this is financial literacy. We don't want to be illiterate anymore. Then once a year, pull your credit report from one of the free online services. Make sure it's accurate. Make sure it's up to date. By law, every American has the right to a free credit report every 12 months. Just go to the annualcreditreport.com and just get yours and see where you stand. Check the websites of the top credit reporting agencies for pointers to improve your score and report errors. Look for the word dispute. Paying after the due date hurts your credit score and can accrue late fees. And I don't know how many of you know, but if you have a really good track record of paying and you miss a month and you're late, you can call. I've called those credit cards and I'm like, hey, you know, I have a really good track record. Could you just give me a courtesy and take off that late charge? And they will gladly do it. So a good credit score can open opportunities to get your lower interest rates on loans and like mortgages. So you want to stay on top of this, and you don't want to, okay, well, it's just $30. I'll pay it this time and I'll be better. Try to ask them to take it off. Most of the time they will. There are 2 tips to paying on time. You should set up automatic payments, or you should consider setting alarms on your cell phone. I actually have a calendar that gives me an alert, and I have 2 days a month. I pay on the 10th and the 25th. This way I take my bills in half each month and I make sure that I'm not late. Of course, sometimes it happens, like I just said, and I'll just call up the credit card company and make sure they take it off. Whatever it takes to make sure you're not late, whatever works for you, you need to implement it now, not later. If you have balances on multiple credit cards, pay down the total balances on one card at a time. Remember, hit the highest credit rate first. That's what you want to do. That's what's bleeding the fastest and causing you to stay in debt longer. Now, if you, this is another thing I was just telling you, they're telling you to pay the balances down one card at a time. Whichever you choose, I'm telling you from my experience, choose the one with the higher APR rating, the higher credit card interest rate. That is the one that's bleeding and making you go into debt faster. I don't care if it has the lowest balance, pay it off. You will be much happier. And then once you're done, take the rest, pay off the next one, and go down in line. That's why it's good to have a whatchamacallit, a list. I can't get my words out now. You get no tongue tied until you pay off all your debt. And it will happen. Like I said, when I started paying down my cards, this was great. I was so happy. It felt so good. It felt very liberating. And you repeat this process until you have no credit card debt or no debt at all. Your goal is to have 0 balances, but don't close the credit card accounts. It's generally better to keep them paid off and accounts open from a credit card standpoint. I used to close my credit cards out, and then someone told me this. I'm like, oh my God, because then they know that you have the ability to have that debt, but you're not doing it. Sorry, excuse me. Okay, then what we're going to do is many people start charging things to stay out of credit card debt, but another way is just make sure that you have the money that you can pay it. So you can charge, and that's what I'll do now. I'll charge. I actually bought a refrigerator. I used my emergency money to pay off the credit card. I charged it on the credit card. I was able to get $200 cash back by doing that. And then I paid it off with my emergency fund and rebuilt my emergency fund. So that's what I've learned to do. And that's a great way to stay on track. And you can also have certain online apps that are great. I'm not an app person. I'm not techie, so I'm a bad example on that. I'm going to skip over the refinancing your mortgage because right now the mortgage industry is not the greatest, but keep it in mind for the next time. And if you want, you can reach out and I can always help you with that. But I know that time is winding down a little bit, so I want to make sure we get through the last 3 milestones. So the 5th milestone is increasing your cash flow. I mean, who doesn't? And I'm sorry about this pop-up. Let me just stop this. So sorry, guys. Okay, I apologize. Increasing cash flows. Well, most suckers, and that's part of the book thing, so I apologize, but most suckers, they gripe about how tight things are. but the wealthy are plotting on how to free up more cash flow. This is the difference between a wealth mindset and a scarcity mindset. Scarcity says, oh my God, things are so tight. I got to stop doing this and I got to do that. The wealthy say, no, how can I increase my income? How can I bring in additional income and manage my expenses better? So let's take a look at some of this mindset. Cash flow is the money that you have available to spend or save. After you've established your proper protection, remember your emergency fund, and you focused on your debt management, you're now ready to zero in on growing your income. And more income can accelerate everything you and your financial professional are working towards, right? That's the key. Who doesn't want to make more money, right? That's so crazy. Now you may feel like George, where you're plumb stuck. I love him. Plumb stuck with your budget and finances. But after learning about the many options and ideas out there, almost everyone can find a way to get unstuck and create more cash flow. So let's look at ways to get your unstuck by finding your fire in the hole chili options. I love this. I really do. So here are a few things that you can do to increase your cash flow. Create and stick to a budget. You can develop a written game plan. It's very important. Write it down. Don't keep it in your head. We all have so many things in our head. Write it down and read it every day when you wake up and every night before you go to bed. Reduce spending on expenses like car and home insurance. When I do budgets for my clients, that's the first thing we do. I'm always looking for what can we take down? Are you having too many coffees? Are you eating out too much? Do you have too many memberships? Are you buying too many clothes? Are you getting your nails done too much? Are you here? This is stuff that you can do. And then you can reposition your savings. Like you can drop private mortgage insurance on your mortgage. You don't need that if you qualify. Your financial professional can help guide you through different ideas. And again, this is not a cookie cutter solution. So everybody has a different way that they can do it and different things that they can work on. There are 3 big moves to supercharge your cash flow. Add a side gig. So when I needed more cash flow because I was in debt and I had this opportunity to start my own financial agency, I'm like, yeah, I'm on. I can help people get out of the mistakes that we made and help them get into a better spot. And I can help people not do the mistakes. This is awesome. I wanted to make an impact. So I'm adding another business to my repertoire. I'm a multipreneur, right? So earning additional income is almost a quicker way to reach your financial goals than just trying to spend less. A recent survey found that 45% of US workers have a side gig earning an average of another like $1,100 per month. Maybe it's time that you look at something like that where you can fit in that might be part-time with flexible hours. You can start, there are low-cost business opportunities. I know a lot of you are coaches, but there are other opportunities. Look, I have a marketing company, right? But here I am 3 years later, and I'm a certified financial educator, a registered representative, and I'm helping hundreds of families and businesses get in a better financial state of mind, and I'm bringing in additional income. So it was a win-win. I'm a business owner in both businesses, flexible hours, and with Zoom, there's no limit to your possibilities. And as your income increases, you can transition away from whatever part you don't like. Maybe you don't like your job anymore and you want to just go full time into that. Or maybe you like both and you just want to keep it. That's fine, but at least you have choices. Adjust your W-2 allowances. Again, this is for the United States. I don't know if any of you are out of the United States on this call, but we have W-2 allowances, and sometimes you talk to your tax accountant and they can help you adjust that so you can bring more money in per paycheck instead of having more taken out in taxes. Now, number 6, we're going to build your wealth. Who doesn't want to build wealth, right? So we're focusing on building wealth, and this is the milestone where your results will appear in your bottom line. This is where you want to avoid the impact of taxes. You want to avoid losses, and you want to hopefully avoid inflation and do your best to accumulate and grow your net worth. So what does that mean? With the possibility of longevity adding up so many years to your life, that brings one question. Will your wealth last as long as you do? Or are you going to, God forbid, outlive your money in retirement? That's a scary thing. More people I speak to are not afraid of dying. They're actually afraid of living and not having enough money to live on in retirement and being a burden on their family and their friends. So, and here I got ahead of myself, the 63%. For retirement age couples, there's a 50% chance that one spouse is actually going to live to 95. Now, most people years ago didn't live 10 years past retirement. Now, a lot of people are living 30 years into retirement. So here is the main point of milestone 6. Whatever stage of life you're in now, you have to start to build your wealth. You can't wait. You can't keep postponing it and putting it off. Yesterday is better than tomorrow. So as you go on this wealth building, and there are 4 disciplines to help you stay on track and not lose ground. So let's look at them. Save regularly and don't touch it, and review your goals and make adjustments when it's necessary. In addition to that, there are 4 threats that every wealth builder has to conquer. And I'm sure that as coaches, you see this in your own coaching practices with your clients, right? Whenever you have them do any goals, there's procrastination, right? So if you procrastinate, you lose very much time that you could have been building your wealth. There are people that are in the market and they want to beat the market, and then they have losses. And every time they have a loss, it brings them down, down, down. You have inflation. Inflation is a success killer. It takes your money. It robs you of your purchasing power. And of course, everybody has taxes. And that is a wealth reducer. So procrastination is the #1 enemy of savings and investing. It is best described as inaction. You're just not doing anything. And the best tactic to overcome that is prioritization. You simply move the 5 actions to overcome your financial procrastination to the top of your to-do list and flag them as urgent and get started on them as immediately. You have to get out of your comfort zone. There's no growth unless you're out of your comfort zone, and you never get back lost time. Once you lose that day, that's gone. You can't go backwards. I wish there was a time machine. Believe me, I would go back to 30 years ago at least and start all over again, but to keep the knowledge I have. I can't go back to when I was 21 and didn't know that. So stop wasting time and start moving on this. The impact of inflation is also known as a tax of our time. The annual inflation rate has averaged right about 2.8% for the last 100 years, but now we all know it's double digits. At least it is in America. I'm not sure overseas, honestly, but that's what it is. And the enemy is slowly devaluating our savings by raising the cost of our goods. And a lot of people can't keep on track with it. It's very, very hard, especially when you're living paycheck to paycheck. Now, the impact of losses. It's the next enemy. We underestimate the threat that it could wreak on our savings. Most people say, well, our financial professionals say, just ride it out. It'll come back. The market's going to come back, but you're losing out at future value. And so supposedly, if you were to lose 50% of your investment, which happened twice in the stock market in the last 20 years, believe it or not, what percentage would you need to gain back to get to 100%? The answer is 50%, right? Is that what you think? Well, if you thought that, wait, sorry, I'm locked. There we go. If you thought that, you'd be wrong. You need to get 100% to get back on track. And that could take years. Some people don't have those years. If you're ready to retire, you don't have all those years to hope that it gets back to where it was. That's why it's so critical not to have any losses in your money. And then what could you do to prevent losses? Well, you're going to diversify your portfolio. We have life insurance, which I told you about as retirement strategies for those that qualify, where you don't have any loss of money and you don't procrastinate, and you have to consider inflation. So you have to talk about that with your financial advisor as well, your financial professional. Impact of taxes, bottom line is, let's try to pay as little taxes as retirement. And that's something that we work on as financial professionals with accountants. But if you could be as tax-free as possible, why would you want to give your hard-earned money to the government, right? They clearly don't know how to spend the money properly. If they do, we'd all be in a better place. And we want to also see if we can get taxed on our seed. Where would you rather pay your taxes, on the little bit of seed money or on the bigger harvest? I would hope that you would say the seed money. If you're putting $100 in a month, I would rather pay taxes on that than let it grow to maybe $250,000 and have to pay taxes in the future where it might be more expensive. And I'm not going to get heavily into this screenshot, but if you want to take a screenshot, please feel free to do so. And again, these are just the ways we're taxed now, tax later, which is tax deferred. and tax never. Again, just for time's sake, I'm not going to get into this. We're running a little behind. Unfortunately, I like to talk. I apologize. So you can take a screenshot, and if anybody wants to reach out to me later on, we can always go over this and I can explain it a little bit more in detail. Okay, I'm going to skip over the next couple of slides for time's sake. And where we go. So we want to really do in this milestone is avoid running out of money in retirement. That's basically what we want to do. And that's where a financial professional can come in. And you've seen all these different milestones. Well, that's what we have to look at holistically, is all the different milestones and how do we make sure you're on each milestone, and how do we make sure that you come out in retirement where you're having peace of mind and not worrying about running out of money. Okay, so over here, there are 3 components of a reliable retirement income. And we recommend that you consider all of them. That's what I recommend. You have to consider all. You have to maintain potential for growth by participating in the upside, where you're reducing or eliminating losses. And lastly, hopefully to become out with as tax-free retirement as possible. These are the 3 ways that you can maximize having money in retirement. And now, are you building wealth for retirement? Here's what it looks like. By stacking up multiple streams of income, this person's going to have a reliable income because they've saved the amount necessary, got the rate of return they needed to reach the savings required to make the retirement they imagine possible. They'll never run out of money and could even have some left over for their legacy for their children. I mean, how great does that sound, right? They're using multiple streams of income. And finally, this is the big thing, is the best money you have is the money that you don't lose. You need to protect your wealth. And if we take a look at this example, Prince died and Aretha Franklin died just a few years ago, and they had very big estates, but neither of them had an estate plan. So they both left their families and business partners with emotional, financial, and legal mess, taking years to sort out. And this shows how important it is to protect your wealth with an estate plan. According to Rocket Law survey, 64% of Americans don't have a will. Not surprisingly, the number is higher for younger Americans than it is for older Americans. Prince was only 57 years old when he died. How is that what you want to leave to your family? I don't think so. We want to make sure that there's a good estate plan set up so that your loved ones never have to worry about what happens with your money and mourning you and still worrying about how the money is. So I'd like to stop there. I hope that this was informational for you. I think I'm right about on time, right, Rena?
Yes, and we have a question here in the chat. So in terms of priority, is it more important to start paying off credit card debt first or save for retirement?
That is a fabulous question. We actually have a bucket method that we teach our clients, because think of it this way. If you have a big debt and you're trying to get out of it, it might take you 10 years, right? Do you really want to not save up for an emergency fund or retirement for 10 years? So when we sit down, we look at the budget, we've gone through a budget, we see exactly how much is extra, we see where they need to, and then we plot out a certain percentage of what the money is to put in each bucket to build up the emergency fund and to build up for retirement while we're paying off debt. It's a beautiful system. And this way, we're attacking everything simultaneously. Does that make sense? I hope that answered the question.
Yes, it's totally.
Oh, should we close? Good, Shauna. So should you close? So no, you shouldn't. I know I used to think you did. Remember, I think I said that, is that you close it, but it actually can hurt your credit rating. What the credit companies want to see is that you have the ability to have the access to this debt, but you're not using it and you're not abusing it. So, and then, like I said, if you want to use the credit card, if you know you need something for $100 and you have the $100 set aside, charge it, build it, keep your credit rating going, and then pay it off with the $100. Just never get ahead, never rob Peter to pay Paul. That's an expression. Never borrow from yourself in the future to pay your present. That's a bad cycle. The debt ratio, no. The debt ratio has nothing to do with how many cards you have out. It's what you actually put on the cards compared to what you owe and what you have as far as your amount. That was one of the slides in there that they said, one of the things is you don't want to, no problems with, you don't want to get rid of those cards because it actually will hurt you. It's actually better to keep them open and not use them. Those are great questions. I love it.
Excellent. So I don't see any other questions. Also, no more questions on Facebook in the chat. How can people get in touch with you? So I know you have some links, some contact information.
Yes. So I only can work with those that are in the US right now. So I'm going to give you my cell number and I have this website. You can always reach out to me through there. That's my main website and my email address. Please feel free, just so that you know, and I didn't mention this before, all of my services are totally free of charge. So I don't get compensated by the clients. I actually work with over 200 companies. And if I'm able to put any clients in a solution, the companies will actually pay me a commission out of their marketing and advertising budget because they didn't have to do anything advertising and marketing wise to get the client. I love it because I can help so many people and not charge them anything. Nothing comes out of their pocketbooks, and I'm still compensated for it. So anybody is feel free to reach out to me, and I would be more than happy to schedule a Zoom call and see if I can help you in any way.
Which is great, especially for those of you who can't afford a financial advisor right now because you have debts. So this is not an additional cost you want to put on your credit card.
Absolutely. If anybody has debts and they want to know the strategy that I use to get out of debt using the rule of 72, that's something we can work on. I have no problem.
Yes, and you mentioned a couple of times the book. Is there a link?
Oh yes. So if you want to, the book is $18 US funds plus shipping. So if you would like to, you could always email me and ask me for a copy of the book. Give me your address and I will gladly mail it out to you. And if you use Venmo, you can Venmo me the money. If not, it's on Amazon. Amazon.com. It's How Money Works. Let me hold up the book.
Perfect.
It's a mirror image, but it's How Money Works. Stop Being a Sucker.
So if you feel like this book is something you want to have a look at, do message Lisa. She's going to take care of it.
It's a great book. It's something you can even read with your children. This is great. It's just very simple, and it goes through all the concepts that we went through today.
Excellent. And so any parting words, because before we end this conversation, if anybody wants to stay on, those who are with us on Zoom, if you want to stay on, once we stop the recording, stay on. If you want to ask Lisa more personal questions, but just to wrap up the recording. So any parting words?
I just want to encourage everybody. When I got on the financial roadmap to health, I was 55 years old, and it's never too late. We have people coming on 60, 70. It's never too late. And don't be afraid. Don't think you're embarrassed or anything. You have to say, look, I don't know. This is stuff that I was never taught. And it really isn't taught in school. So this is something that can empower you to get your life back, not only in your home, but in your business. It's made a tremendous difference in my business also as well, because when you're financially illiterate, everything suffers and you're stressed and you have anxiety. So this is the best medicine. Financial literacy is the best medicine, and it's the best medicine for the financial curse and the cancer. We have the cure. So please feel free to reach out and don't be ashamed.
Excellent. So we definitely are going to post this video on YouTube. Those of you who are going to watch the replay, reach out to Lisa. It's totally free, and her partner Tracy. And I really enjoyed this conversation, and it's good to kind of like have that at the back of our minds. Now that we're finishing 2022, I got a feeling next year is going to be awesome, financially, emotionally, mentally, in any way. So yeah, but definitely it's an important topic for me as well to pay more attention to my own finances. So I got inspired. So I'm not American, so I can't use your services, but it's good. I can find somebody else.
Anybody know, even if it's yours, family members. We do have offices in Canada. I am not licensed in Canada, Elizabeth. I wish I was. Eventually, I'm going to plan to be, but I'm only statewide now. So If you know anybody in the States that might need this free help, I would love to be connected. Tracy, my partner's on as well. We'd love to help. I know. Eventually, they have strict rules. So I have to wait till I get to a certain level. I have to get to my broker level, and then I'm going to reach out and get into Canada. But if you want to reach out to me anyway, Liz, I might be able to put you in touch with one of our offices in Canada that they'll be able to offer you the same kind of help if that works for you. No problem. I'm happy to do it.
Well, thank you so much again, Lisa. Stay on with us for a few more minutes. I'm just gonna start recording. I love this conversation. It's such an important topic. I hope you learned something new or got good reminders today. And thank you so much, everybody.